Hello everyone. I will continue with chapter 2 in this lecture. So we now look at some of the working mechanisms of security markets. So we start with the trading hours. So trading hours for security markets generally ranges from 9:30 a.m. to 4 p.m. And most security exchanges as well as electronic crossing networks provide before and after trading hours. So after trading hours session is used to match identical buy and sell orders. The laws which govern security markets are multiple. So some of the prominent ones are Sarbanes-Oxley Act of 2002. So it was enacted to prevent corporate fraud. The Dodd-Frank Act of 2010 was enacted to promote financial stability and ensure risk management in financial institutions. Apart from that, there are demands for ethics, moral and proper conduct in security markets, and also blue sky laws. Blue sky laws have been enacted by individual states. It is to prevent investors from being sold wrong products or unsuitable products. So these are some of the key regulations which govern securities market. So you can go through more details about these laws in the textbook. Also, there is a brief synopsis of each law or each of the important laws in the next few slides. So now we look at the different types of transactions that are possible in a securities market. So these are long purchase, margin trading, and short selling. Long purchase means I use my own funds to buy a security. I hold the security for some time because I expect income in the form of interest or in the form of dividends if it is a share. Then I will sell the security at a future date when the price of the security appreciates. So in this way, I also earn capital gain. However, there is some reduction because of the transaction cost involved in buying and selling of securities. So this is the most common type of transaction that happens in securities market. The next is margin trading. Margin trading means I am borrowing funds from brokerage firms to buy securities. So there is a margin requirement, that is the minimum amount of equity that investor needs to use. It is say 50% for buying for margin trading of shares. So why do investors engage in margin trading? Because they are able to use borrowed funds. So they are using leverage, and financial leverage helps to magnify their returns. So what is margin loan? Margin loan is actually the way in which the borrowed funds are made available and used in buying of securities. So this example helps us to understand how margin trading works. So if you look in the extreme left column, this is with 100% equity. That is, the investor uses their own funds to do the transaction. The cost of investment is 5,000. There is no borrowed funds. The stock price increases to 8,000. So there is a capital gain of 3,000. So the return on investment is 60%. Now for the same transaction, the investor would have borrowed $1,000 and used $4,000 of their own funds. If the stock investment had increased to 8,000, then the capital gains would have been 3,000 and the return on investment would have been 3,000 by 4,000, which is 75%. So what we notice is if the share price increases, margin trading helps to increase the return on investment. Similarly, if the price falls below the original price, then the losses are also magnified. So what are the advantages? It helps to magnify returns. And if an investor has limited capital, they can use margin trading to invest in multiple assets. So in a way, margin trading helps to promote diversification. What are the disadvantages? It also magnifies loss if the asset price falls. Plus, there is also an interest burden of borrowing funds. So what are some of the key concepts related to margin trading? So you have a margin account where the investor has to deposit funds, which will be used for buying shares. Then there is an initial margin, that is the minimum amount of equity that the investor must use. Restricted account means an account which has equity less than the initial margin requirement. And maintenance margin is the absolute minimum amount of equity that must be maintained at all times. If due to the share price decline, the equity margin goes below the maintenance margin, then there is a margin call. The investor has to top up the margin account, bring it back to the maintenance margin. And debit balance is the money that is borrowed for margin trade. So margin account has money of the investor. It has to be maintained to a certain level. If share price falls, the value of money in the margin falls because it is held against shares. So the investor has to replenish that account and bring it to the maintenance margin. So these are some of the initial margins, that is the initial margin in terms of share value that has to be maintained. It's generally 50% for stocks and some of the bonds. So 50% of the bond or 50% of the stock has to be held by money provided by the investor. So this is a formula for calculating the margin. What is the total value of securities which is bought? And debit balance is the amount of borrowed funds. So that gives us the margin amount. So this formula helps to calculate the return on investments for margin trading. What are the uses of margin trading? Magnify returns. That is the primary reason. But also there are problems like risk, like if the price declines, so there are risks associated with the margin trading. Plus, there is also a requirement to maintain margin at a minimum level when investing through margin trading process. Now we look at short selling. Short selling means the practice of selling borrowed securities. So the investor will borrow securities from a broker. They will sell it and with a promise to buy the same securities at a later date. Investors will undertake this kind of transaction if they believe the price of the securities will decline in future. So they are selling at a higher price and buying back at a lower price. And as a result, they are generating returns. So to do that, you can look at this example, 100 shares sold at $50 per share. So the initial sale amount is 5,000. The share price declines to $30 per share. So they are bought back at 3,000. So the net profit is 2,000. There can also be margin trading for short sales. So in this case, an initial margin has to be deposited with the broker, after which the shares are made available and the shares are sold. And in case the price declines, so there is a profit generated, and because it is on margin trading, so it magnifies the profit. Similarly, if the prices increase, the share price increase, then it also magnifies the loss. And here, if you see, there is a margin call because the margin maintained with the broker has gone below the maintenance margin. So what are the advantages? So an investor can earn profits when the stock price declines. What are the disadvantages? There are limited profits because the stock price cannot go below zero, but the risks are unlimited because the stock price can go up to any levels, and that will increase the losses for the short seller. So these are some of the concepts related to security markets and transactions. That's all for chapter 2. Thank you.